Welcome to this video, and in this video we will explain when a stock is overvalued. When a stock sells for more than its intrinsic value, we say that the stock is overvalued. Intrinsic value is basically an estimation of what the stock is really worth. So a stock that is actually worth $100 but sells for $200 is what we call an overvalued stock. Stocks can become overvalued pretty quickly when investors perceive the company as more valuable than it actually is. And this overvaluation is often caused by emotions. A common example of how a company becomes overvalued is when it becomes popular in a short period of time. Those companies often carry massive expectations of investors, who believe it will be the new Microsoft or Apple, for example. Now, many investors hop on the bandwagon because they cannot resist the hype and future profits that are promised. Now, what will happen when you think a company will become the new Apple or Microsoft? You pay a little more than what you normally would for the company because you expect a huge profit anyway. Now, as long as the hype continues, investors are willing to pay more and more for the company, inflating its price. And after a while, the price has been inflated to an extreme point. Expectations are higher than ever, but the actual results are not yet produced by the company. A company like that is often subject to what they call a bubble. And a bubble is caused when the price of a stock is increasing and increasing without any real arguments to justify the price. This is what we call an overvaluation of a company. Eventually the bubble must burst, because 9 out of 10 companies, if not more, won't become the new Apple or Microsoft. Probably the best example of a period where stocks were overvalued was during the tech bubble. And in this period, almost every internet-based company was trading on the stock market at absurd prices. Most of these companies didn't even earn a profit, but investors poured millions in them, believing that these companies were part of the start of a new economy. However, reality hit and it sent stock prices crashing down. This is a perfect example of how a massive hype and following the crowd caused massive overvaluations in the stock market. Investing in overvalued companies is like playing with fire, and eventually you will burn yourself. So when a company is the hot topic of a cocktail party, you know it's probably time to move on. Investing in undervalued companies is a much better strategy. And if you want to learn more about that, you can click on the link in the description. That's it for this video, and I hope you enjoyed it and that you learned a lot. Now, if you have any questions or any comments, please let us know.